All right, let's dive right in. Today we're going to talk about a huge mistake a ton of investors make when they look at financial stocks. You know, it's one of those simple rules of thumb that works great for almost every company except for banks. And getting this one wrong, it could mean you sell a fantastic stock right before it really takes off.
So, be honest, have you ever been looking at a bank's financials? You see that big, scary, negative number next to operating cash flow, and you just feel that pit in your stomach? Maybe even smash the sell button thinking you were being smart and getting out ahead of a disaster. Well, if you have, trust me, you are not alone.
I mean, it makes sense. We've all had the golden rule drilled into our heads, right? Negative operating cash flow is a massive red flag. It's like investing 101 for finding healthy, stable companies.
And look, for pretty much any other business, say a cement factory or a software company, that rule is absolutely gospel. If a company is spending more cash than it's bringing in just from its day-to-day business, it means it's literally burning money just to stay alive. The advice is simple: run away, fast.
But, and this is the whole point of this explainer, here's the massive twist. When it comes to banks and other finance companies, that golden rule doesn't just bend. It can be completely backward. Seriously. Applying that factory logic to a bank can trick you into selling an amazing company that's actually gearing up for a huge period of growth.
So, what gives? Why are banks so different? Well, it all boils down to this one single core concept. For a bank, cash isn't just something they use to pay the bills. Cash is their product. It's the inventory on their shelves. A bank's entire job is to move that product, to get cash out the door in the form of loans.
And that simple fact creates two totally different playbooks for understanding cash flow. You've got your standard factory logic, which we all know, and then you have bank logic, which you'll see works on a completely opposite set of principles. Let's put them side by side.
And wow, when you see it like this, it is just night and day. With factory logic, cash heading out the door equals trouble. A big red flag. But with bank logic, cash outflow can actually be a fantastic sign of growth. It means the bank is doing its job. It's selling its product, money, by lending it out to customers.
Let's dig into that bank logic a little more. When you see a bank showing negative operating cash flow, what's often happening is it's creating a bunch of new loans. And those loans, they're assets. They're going to generate interest income for the bank for years to come. Now flip that around. A big positive cash flow could actually mean the bank is slamming the brakes on lending or even calling in old loans. That might be a sign of a shrinking business.
Okay. So you're looking at a bank statement, you see that negative number. How in the world are you supposed to know if it's the good kind of negative, the growth kind, or the bad kind? You definitely don't want to be guessing. Well, luckily, the folks over at Smart Capital Academy came up with a dead simple 2-second check you can use to figure it out instantly.
Here it is. It's this simple. Before you panic, before you do anything, just ask yourself these two questions. Number one, is the bank's revenue, its interest income, actually going up? And number two, is its total pile of loans, the loan book, getting bigger? The answers to these two questions tell you everything you need to know.
So let's play this out. You see negative cash flow, but you check and see that revenue is rising and the loan book is expanding. Boom. That is a fantastic sign. It means the bank is investing in its own growth. This is not a company in trouble. That negative cash flow is the fuel for future profits. This is what you call the buy zone.
But, on the other hand, if you see that same negative cash flow, and then you check and the bank's revenue is flat or even falling, and its loan book is getting smaller, now you've got a real problem. That combination suggests the bank is actually losing money on its operations, and its core business is in decline. It's liquidating, not growing. This is the scenario you want to avoid.
So, what's the bottom line for us as investors? It means we have to throw out that one-size-fits-all rulebook. We have to adopt a whole new mental model for looking at cash flow, especially when we're in the financial sector.
And if you take away just one thing from this entire explainer, please let it be this. In a manufacturing business, cash leaving the building is an expense. But in banking, cash leaving the building is an investment. It's such a simple distinction, but it fundamentally changes everything about how you analyze the company.
So the next time earnings season rolls around and you're digging into a bank's report, don't just see a negative number and hit the panic button. Instead, ask the much smarter question. Where did the money actually go? Was it burned on expenses or was it invested in future growth? Knowing the answer to that is what will make you a much, much better investor.